So we have a special voice joining us on the show today. You may not have seen him very often. Of course, he's busy setting up a new AMC at White Oak. I'm talking about Aashish Sommaiyaa. Aashish, thank you so much for your time. Nice to have you on the show after a long gap. Now, till some time back, we did see India lagging. In fact, on a net, if you see, India is still lagging behind, whereas global markets are making fresh highs. Now, it seemed to be bouncing back. That is because of some amount of recovery is coming in, and things are market is discounting far away, 6 months far out, and things are bouncing back in the market. What are your thoughts, Aashish?
Yeah, I think in the last, since the time we encountered March 2020 and then the subsequent run-up, I think there have been bouts or periods of time where India has significantly outperformed or been even the best performing market vis-a-vis emerging markets. And, like you rightly pointed out, yes, currently we are going through some kind of a correction or a minor correction or a sideways movement for two reasons, I guess. I think one is everybody would like to wait and watch, because we've already commenced the result season. The September and December quarter results were ahead of expectations. And I think a couple of quarters people might want to watch for sustainability of that performance. Also, I think financial sector, as a result of the second wave, is there any further strain which is being caused on the books of financials, etc. So, yeah, I would not get overly concerned about what is happening, especially in the stock markets right now. I would rather think that, this is more a phase. Maybe next couple of months, we might see sideways movement, and we might also see investors watching out for sustainability of corporate performance.
Right, Aashish. But if you look at the way the last 48 hours, the market has got a boost because of the commentary from the earnings season. Most of the numbers so far are coming out in line or with a positive tilt. But don't forget that the general expectation was that this will be a strong earnings season and hence very less margin of error. What are your thoughts on the corporate reporting?
Yeah, see, whenever you look at the key sectors, I think say IT, things are as per expectation. If you see, for example, financials, well, that is something to watch for. But till now, whatever results have come, they have surely been in line with expectations, and in fact, a couple of them have been really good. So I can say that early days result season has kicked off quite well. I don't see that there are too many negative surprises at all. In fact, on the other hand, if you see cyclicals like metals, etc., it is widely expected that they are the ones which will lead the aggregate level growth in earnings. So I think, when we are done with FY20, FY21 numbers, I think on an aggregate basis, we will have reason to cheer. That's what it looks like. What is more important from here on will be actually to see the sustenance, given what has happened with the second wave, and we've seen localized kind of lockdowns. What is the real impact on activity? I think we might, since the markets have already run up quite a bit in the last 6 months, I think next quarter sustainability is what we have to watch out for. But I would put it this way that, it's not expected to be a very, very big impact of whatever we are seeing right now. And we are positively biased.
Aashish, since you spoke about financials, if you look at the top gainers today, it's the financials which are gaining from the front. And despite of the fact that many of them are talking about it in the con calls, etc., that yes, the sector will be impacted because of the second wave as well. And provisions are being made. BFSI segment or NBFC guys are already saying that there would be an impact. On the other hand, IT and Pharma continues to outperform. Sector tailwind or positioning of the investors also favoring them. What are your thoughts in these three? One is extreme risk on, the other is defensive.
See, IT and Pharma, easier one. We don't expect, we don't expect any negatives. In fact, we expect the momentum to sustain. In fact, IT, there is fair amount of excitement because it's not just the large cap bellwethers, but there is a slew of mid cap companies which have kind of come of age, which are also able to stand on their own right as well as differentiate themselves. in the global marketplace. So IT and pharma, they continue to be core holdings in our portfolios, purely even on a bottom-up basis. If you talk about financials, I think we need to see where we are actually coming from, because even before COVID hit us, our system level credit growth was practically zero, and GDP growth was maybe more like 4%. If you see the years prior to that, 2018 is when we had this massive ILFS default, and then like a shakeout in the non-bank as well as the BFSI, lenders specifically, there was a shakeout. And even if you see the larger PSU space, they have been going through M&As and consolidation and capital raise and restructuring. So even before COVID hit us, for nearly 2 years, the financial sector was going through a massive shakeout and a cleanup. So I would say that when COVID hit us, it was more like a slow speed car crash. If we were witnessing record system level credit growth, and if we had seen a period of expansion before we hit upon COVID, the scenario would have been very, very different. But we hit COVID already at a point in time when we were consolidating and kind of restructuring the whole sector. I think as a result of that, you are standing where you are, which is that you are not seeing too much of panic or too much of delinquencies, or reporting of very, very high NPLs. You're not seeing that because of where you're actually coming from. And hence, we remain constructive. We are not very fearful of the next couple of quarters.
Right. Aashish, are there any sectors to your mind which will see headwinds in this kind of an environment going forward? You talk to a lot of guys on ground across businesses. What are the sense you're picking up? Where would be the pressure areas be?
See, there are no strict, at White Oak, there are no strict negative lists, really speaking. Generally speaking, what we've stayed out of is taking macro bets. So as a result of that, taking exposure to, say, global commodities. It's not like they will not make money. Of course, they do end up producing great results if caught at the right end of the cycle. But I think timing those cycles is precisely what we find difficult. So what I'm going to say is not an indicative of our view really, but it's just something that we avoid because of inability to time the macro cycles. So, well, yes, global commodities is one. Second is anything which has huge, intervention from, say, sectors which are largely dominated by the public sector, where there is not much heterogeneity or choice amongst businesses. I think those are the kind of sectors that we typically tend to stay away from. But otherwise, if you were to cast a glance at any of our portfolios, we are pretty much invested across sectors, and we do find bottom-up ideas in literally every sector that one can think of.
Right. All right, Aashish, we'll let you go on that one. Thanks so much for joining us, and good luck at White Oak. I understand you're putting pieces together for this new AMC, which you guys are building. Best wishes for that. Let's take a short break on that note. On the other side of the break, we'll discuss earnings. We'll get you a big financial author and some secrets of super investors and billionaire investors globally, and how to be a great investor yourself and lead a happy life. All of that after this very short break.